Hi, welcome to T-Minus Retirement, the podcast where we help launch your retirement into orbit. I'm Jay Cole.
And I'm Dustin Watts.
We wanted to talk today about just a few terms that are being thrown around quite lately. I'm sure you've heard of a bull market or a bear market or even market correction. This is as of March 20th of 2025. And so lots going on in the news right now, especially with the market. And we just wanted to dive deeper into what do these terms mean, and then specifically go over how these markets were just going through past examples throughout history.
Because they can sound scary when you're in the midst of it. Obviously, it becomes a nightly news lead story of what the market was up or down. And I think it's good to bring some context to it, look back through some previous examples to help you make some sense of what kind of market we're currently in. Okay, so we have some slides here from First Trust. They've put out a slide deck that goes over some of the things that we're talking about. So first, let's start with what is a bull market and what is a bear market, because those are probably some of the most widely used terms. So the bull market, and it shows it right up here in the middle, a bull market is from the lowest close reached after the market has fallen 20% or more to the next market high. Those are, I would say, what we're more commonly in. We're in a bull market more often than we're in a bear market. And if you want to think about it, that's typically when the market's going up. A bear market is when the index closes at least 20% down from its previous high close through the lowest close reached after it has fallen 20% or more. That's when the market is in a contraction. And there's different levels to that. So just because the market's going down, that doesn't mean we're in a bear market per se, but it's more commonly associated when we hit from the recent high a 20% drawdown. The other term, it's not on this chart, but you'll hear it sometimes on financial news, is a correction in the market. And a correction happens more often than a bear market. And a correction is a 10% contraction from recent highs. And the chart here shows us some really interesting data. It goes back to 1942. The blue lines being bull markets, bear markets being in this orange. And then you can see these gray bars. Those are recessions that take place. And to put it into context for you, the average bull market period lasts 4.3 years and has an average return of 150%. So you could see here, the bull markets are a lot longer than these bear markets. Bear markets on average last 11 months with an average cumulative loss of 31%. So if we kind of look back through, some recent years, we can maybe look back through, at least from the great financial crisis here. We had a bull market, in the 2010s to really 2020 COVID. That was an 11-year bull market. It's one of the longest, second longest on this chart, with a 400% return. So, everybody who says you lost all your money in 08, they probably sold in 08 and didn't hold on for this bull market because we recovered and some, and like 300% plus. But the average return, this was one of the best decades actually in the market, in the S&P 500 at least. The average return looks like it was 15.8% over that time. We had a bear market during COVID. That was a very short one. I gotta even get close to the computer here to see it.
1 month.
1 month, and we were down 34%. Now that was a flash crash type of scenario, obviously because of COVID. But then we rebounded from there. We had another bull market. The most recent bear market that we've had was in 2022, and I think that's something that people can look back to because it wasn't that long ago. We can kind of imagine ourselves in that position again. We had a bear market due to high inflation and the Fed aggressively raising rates to get that under control. And that triggered a 9-month bear market, and the market was down 25% over that time. And since then, we've been in a 2.2 year bull market. Market's up a lot, 64% since then. And currently, as of filming, we've gotten into a technical correction. So we've pulled back 10% from those highs, those recent highs. And a correction, first and foremost, people need to know is completely normal and healthy. I think that's the thing that gets lost, is just because we're not at an all-time high doesn't mean that it's everything's coming to an end. Corrections happen all the time, and we're going to talk a little bit more about that towards the end of this slide deck.
Yeah, sometimes a lot of these companies, like in the S&P 500, can get way overvalued for different types of reasons, and corrections help pare back that overvaluedness.
Yeah, markets create excess over time and exuberance, and that kind of gets flushed out. And it typically, when we get into these pullbacks in the market, the pullbacks happen much quicker than the run ups, and that's just kind of human nature. We'll keep going here in the slide deck. I'm not going to hit all of these, but one that I think is important, since we were talking about corrections and bear markets. So look on the left-hand side here on this table. This is the S&P 500, over since 1942 to 2024. And I think this is a really important thing to touch on. We have 5%, 10%, 15, and 20% declines. Some happen more often than others. But if we look in this correction territory, and remember that's about 10% down, corrections in the market happen about every 16 months. They last about 128 days. And the last one that we had was less than 2 years ago. So people need to just remember that you've been here before. When we have these periods of time, we don't abandon our investment philosophy. We don't, throw in the towel and make changes and move to cash and do all these crazy things. We remember what we own. We assess the situation where we're currently at. And, if a change is warranted, that's one thing. But a lot of times we've set portfolios up, your 401k, you're contributing to it. You want to take advantage of these times if you're able to. You don't want to make drastic changes, especially near the bottom of these periods. And that's the thing. Nobody knows where that bottom is going to be.
Right.
Sometimes corrections turn into bear markets, and a lot of times they don't. So, we just need to kind of stick with the plan.
Well, the problem is, okay, if you pull everything in cash when it's a correction, let's just say, when do you put it back in?
Yeah.
Because sometimes it could be, you could recover from that correction and then goes back to that same territory, if it's within a week or so.
Yeah.
So it's hard to tell when you can put that money back in.
If you're not a professional trader, timing the market is something that most people do incorrectly almost exclusively. So, we really try to have people not do that, because you do more harm than good.
And you could miss out on, the next day it could go back up.
Yeah.
It could be a drastic increase.
Well, and we'll look at that chart next, because that's a good point. But if we just look at 20% declines or more, they happen about every 5.5 years. They last on average 335 days. And the last one that we had was in 2022. And looks like October is a popular month for this stuff. But just remember, this isn't uncharted territory. Even what's happening in today's markets, we've seen some of this before, right? 2018, there was tariff talk. We had the market decline 20% in the fourth quarter of 2018. And it was a negative year in 2018. I think markets were down, 8, 10%, something like that at the end of the year. And 19, 20, 21, 22, they were all positive return years in the market. So, just remember, you've been here before and these things happen, and we don't want to make big changes during that time. And here's one of the reasons why, to Jay's point, he mentioned, you don't want to go to cash and then try to time getting back in. Most people do that, unsuccessfully. What this chart is showing is the performance after the S&P 500's worst days in the market. And this is ordered, the worst day ever was back in 87, all the way down. They've obviously ranked them the top worst days. But the big takeaway here is 1 year later, after the markets had one of its worst days, other than 2008, it looks like, 1 year later, all of these returns are positive, and they're positive by double digits.
Yeah.
I mean, some of these 66%. So this was COVID. I mean, I remember this, the Dow was down, what was it? 10%, 7,000 points, something like that.
Yeah.
It was definitely wild times. And then a year later, we're up 66% from that time. And, just from my own experience, of course, talking with clients, and people want to pull out. People wanted to pull their entire 401ks out, sit them in cash. And they always say, I'll sit this one out. I'll get back in when things calm down. Well, here's the problem with that. The market bottoms on some of the worst news. And I always tell people, I promise you're not going to want to get into the market when you need to, because that's when the news is just so negative. Everything seems like it's falling apart. That's when the market puts in that eventual bottom. And if you don't get it back in there, you're kind of always chasing the market higher. And then you say, oh, well, it's going to come back. Oh, it's going to come back.
Mm-hmm.
And
that's the thing. You don't know when to put it back in.
Sometimes it doesn't, So 3 years later on this chart, there's 0 times that we have a negative return. I think that's really important to think about, because most people don't need every dollar they've ever saved in the next 3 years.
Yeah.
You have more time to let some of these things shake out than you think. So just remember that. So I think these are, looking back through history, these are some really important points to just keep in mind when we have volatile markets, because you've been here before, and we don't want to make these same mistakes that others have made.
And this is maybe more of a side comment, but this is probably why it's good, where if you don't want to tolerate the risk of the S&P 500, it's good to have some type of a diversified portfolio where you're not experiencing the extreme highs and the extreme lows, within those days. A diversified portfolio could help tailor back that risk, and instead of being down 20% in 87, I'll just use that as an example, it could be 15% or it could be down 10%. It's good to have that if you want to tailor whatever risk tolerance you're comfortable with.
No, I think that's a good point, because even if you look at what's going on in today's market, what has corrected the most in the markets right now in 2025? It's been large cap growth. Mm-hmm. It's been, in technology in particular, and it's been names that are up hundreds of percent over the last couple of years.
Yeah.
God forbid they're down 20 to 30% after making a few 100% return. I think everybody can give, they can give a little back, and it's not the end of the world. It's honestly, it's very healthy for these things to do that. It allows us to set up for the next leg. That doesn't mean that the next leg is tomorrow, but it's definitely not, doesn't mean everything is over either. Mm-hmm. Last thing I wanted to hit on, there's a lot going on this chart. There's a lot of these slides, but you just got to remember that out of the last 99 years, it looks like 73 of those years are positive, 26 are negative. So let's just say roughly 73% of the time, I guess it's 74% of the time, the markets are positive. And some of them, sometimes they're on these kind of outliers where, these are years where the market's up the most. These are years where the market's down the most. But look how this is kind of skewed. Up 28+% has a lot more outliers up here than the down years. The average positive return is 21.5%, whereas the average negative return is 13.4%. We're going to live through some of these years. I think most people can handle, we're down, let's just say we're down 15% somewhere. The majority of them are kind of in this range. Most people, I think, can handle that. And you reap the rewards for living through some of that. And the reward is almost 10.5% annualized returns over 99 years. This is what gets you to your goals. This is what allows you to retire comfortably. This is what allows you to build wealth. What doesn't is trying to time all these different years and think that you're going to be in and out of the market and panic. It's just own good companies, invest for the long term, and have a plan, and you'll do just fine.
Yeah, just stay the course. That would be our advice.
Yeah. So we hope that you found some value in the slides that we've shown today as we discussed what bull markets look like, bear markets look like. If you did find some value, please like, subscribe. We'll see you in the next video.